Good morning, everybody, and welcome to the Australian Market Preview for Friday, 11 December. My name is Carl Capolengua. I'm the market analyst over here at ThinkMarkets, and it is a pleasure to be with you as we round off what has been a very interesting, very exciting, very eventful week on markets. And today may actually be the same. A few things going on. We'll talk about that after we talk about the ThinkMarkets Difference, which is substantial $8 flat rate trades, your own holder identification number, and unlimited phone support. When you consider there's no subscription or platform fees, they are four fantastic reasons why you should consider us before your next ASX share trades. And I'm going to give you 10 free trades when you switch to us before the end of December. So get onto the website, download the app, open an account right now. The agenda for this morning is to have a look at the COVID situation, trying to find some downtrends there. That would be nice. We'll try and find some uptrends in some of the markets as well as we look at market moves and technical analysis. We'll bring it closer to home and have a look at which companies are paying dividends, which are going, which have any news and which are showing broker moves at the moment. Then we'll round off by looking at the macro economy. Okay, let's kick off with the COVID case. No official numbers for Europe through for December 9, but they are just trickling lower. So they are under 200,000, over 200,000 in the US, and that rise continues seemingly unabated, particularly concerning when you consider the unemployment data that came out last night for the week to the end of December 5. And we'll talk about that in just a little while. Otherwise, the trends around the world appear to be heading in the right direction. Some of them a little bit flat. For example, Japan flat to up, China flat to up, but off a low base, and down in Australia. Okay, having a look at the performance of the Aussie market yesterday, and it's the first time in a long time, look, I've just noticed that everything is red, a broad-based move lower. It wasn't a big move on financials, for example, on energy. I would expect energy to do well when we see the crude oil prices coming up, but gold got smashed, 3.56%. Technology got smashed, 2% on the back of a 2% fall in the NASDAQ from Wednesday night. Material sector pulling back 0.7%. Telecoms down 1.5%. Not a great sign for the underlying strength within the local market when everything gets hit at the same time. In Asia, it was a more modest decline. Nikkei down only 0.2%, but the Shanghai actually managing a very small gain there. How will we respond to the US markets today? So those moves down on the Dow, very small down on the S&P 500, but a nice up on the NASDAQ. When we see the charts, the technical picture has firmed considerably. Volatility index about the same. That's not too bad. In Europe, FTSE was nicely higher, but a mixed performance on European markets. Metals prices, certainly some of them still on a tear. Nickel up 4% in a session. High-grade copper up over 2%, and iron ore grabbing all the headlines once again today, up nearly 6% in early trading on the Dalian Commodities Exchange in China, up 3.5% in the US dollar price. Gold down a little, silver up a little, but look, iron ore stop the press after that. Crude oil up 2.6%, Brent crude up nearly 4%. That will certainly embolden the energy sector today, with one caveat, and that is the strength in the Australian dollar. So we're seeing our futures tracking lower today. My hunch is it's on the back of the significant impact this surge in the Australian dollar is going to have on our overseas earners, undermining those earnings. The US dollar index down 0.3%, but clearly that risk on commodity-focused Australian dollar is the big play in currencies at the moment. Bonds coming down, bond yields, I should say, coming down, bond prices going up, and that would no doubt be on the back of that awful weekly jobless claims report. We'll talk about that in a second. What is interesting is when you have such a horrific report like it was in terms of economic growth, employment, very important for economic growth, and the S&P 500 actually finds a support level there at 36.46 and bounces, tiny bounce. So not getting too excited yet, but at least it did, or at least it has appeared to be respecting a nice support level there at 36.46. So we want to see a follow through today. It's not enough just to get a little bounce there and a rally off the low. We want to see it close on the high. It didn't do that. We want to see a follow through now to confirm that we are still in this higher peaks, higher troughs phase, and we're going to go up and make a new high. The NASDAQ was a far better performance, and this encourages me. I note also the broader Russell 2000 index was up very strongly as well. That's encouraging. But respecting the key support level here at 12217, bouncing and closing far closer to the high again. We want to see how it follows through to tell us we are still in this short-term uptrend. This is one very interesting and very concerning item, though. This is not consistent with risk on around the world, and the share price index futures contract trades overnight in response to US markets, which we saw are pretty good. It trades in response to those moves on the London Metals Exchange, which we saw were very constructive for, the Australian metals sector at least, but more broadly the Australian economy. When the metals material sector is firing, it's good for employment, certainly in my home state of WA. That's good for consumption. It's good for royalties. It's good for the government budget. It allows the government to spend more money to stimulate the economy. So you would ordinarily think they were all good things and great leads for the Aussie market, but we have seen quite a sharp fall in the SPI futures. We're looking for the shape. The shape's not good, not pointing to a strong day today for us. And the close relative to the high and low, closing closer to the low than the high, is not good for us as well. In fact, we're pointing to a 0.7% decline, and I think we're probably going to get pretty close to that today. It's not about how we open, it's about how we close, but that's not giving us a great indication. So we could see a move lower today, which makes me think, where are we going to go to? What levels could we probe? Certainly 65.11, I think, is going to be a key support. Maybe 6,600, a little bit of a round number there, possibly. But until we see some price action, for example, a candle that looks something like this, where we see that supply in the morning and the demand come in to tell you that whatever move you're in prior to that is probably completed. That's the one we want to see, and it's got to happen around where that question mark is. I could be wrong. I hope I'm wrong, and I hope we just go up today in response to some of those positive leads. I'm not sure that's going to happen. I think the negative impact, the negative drag from that higher Australian dollar is going to hurt us. Okay, changing gear a little bit, we'll head over to dividends. We've got United Malt Group paying today. The rest of them are next week. Press pause and see if your stock is on there. Broker moves in the last 24 hours, or at least since the close yesterday. Jefferies has lowered their price target on Appen and came out yesterday, downgraded their profit guidance range from sort of a mid to high 120s down to 106 to 108 million for the full year. So, percentage terms, it's probably a 10 to 15% hit in earnings, conservatively speaking. And we've seen the price target come down about 20% here from Jefferies on Appen to $32. The stock was hit hard yesterday, down about 12% off the top of my head. BHP, though, the haves and the have-nots. BHP on the way up. Appen saying, look, COVID is affecting their business operations in the US. 85% of their operations come from the US. They said that the strength of the Australian dollar, well, that's topical, isn't it? The strength of the Australian dollar is hurting their earnings as well by 2 to 3%. Now, BHP, it's the beneficiary of what's going on. It seems that COVID has sparked this belief, whether it's reality or not, belief that we're going to have this huge infrastructure spend over the next few years, that growth will return as governments focus on stimulation, both from the monetary and the fiscal side of things. And BHP and Rio are the key beneficiaries, and that's why we've seen commodity prices go through the roof. So Morgan Stanley increasing their price targets. Now, these are in Great British pounds, but it gives you an idea of the size of the gains. So you can convert those back to percentages for what it means for the local listings. 42.90 to 52 is a big jump. 16.80 to 9.60, pretty big jump as well. We're seeing some brokers come out and become more positive on coal stocks as well. 130 to 155 Citigroup on New Hope Corporation, and then on Whitehaven Coal 135 to 2. That's a massive pop. Some of these coal stocks are really looking quite interesting. I mentioned it on AusBiz, I think it was last week, that I'm starting to see signs that we can move back into that market. I'll keep you updated in Think Technical. This has gone haywire. It's an upgrade from hold to buy. Not sure why the system didn't pick that up. Bug in the software, but that's what happened. And price target going from 14 cents to 33 cents on 7 group holdings from Jefferies. Okay, having a look at some of the data from yesterday and then overnight in the US, we saw M2 money supply new loans come out. We're holding near 3-year, 4-year highs on M2 money supply. We saw 10.7% growth in November. That was up from the 10.5% we saw in October and ahead of expectations as well. And then we saw the new loans, and that surged as well. 1.43 trillion yuan versus 1.4 expected, and doubling the number from the previous month. So the more loans have been made up until the end of November than all of 2019. So some still bullish signs there on the Chinese economy. Having a look at inflation data in the US, and there's not a whole lot there to talk about, which is a good thing. We were 0% in October. We're only 0.2% in November. The trends are lower. That's great. And the Fed will be pretty happy to continue to, stimulate the US economy without too much concern of inflation at this stage. What they will be concerned about is the employment situation in the US and the possibility, the very real possibility, of a double dip recession on the back of this resurgence in COVID cases. So we're seeing, states having to make tough calls here about restricting movements again. That's impacting businesses. We talked about the Appen guidance earlier on, and it's businesses, they don't want to hire and they may have to let people off. And we're seeing that now flow through to a weaker non-farm payrolls report last week, the weakest growth we've seen since the start of the recovery, and a tick up here, 3 out of 4 weeks higher on the weekly claim. So it came in at 853. That's a big jump from the previous 716 and well ahead of the 723 expected. Big jump also in those claiming for emergency pandemic support as well. They were up by about 4 million. There's now 13 million Americans on that emergency support. So does indicate how important it is for this fiscal stimulus package to come through. Over 20 million Americans are still unemployed. Plenty of work to do there. Okay. Data coming out today locally, nil. Data coming out tonight in the US. We've got the producer price index this time. So we saw the consumer price index. Now we've got the producer price index, or wholesale inflation, and then the preliminary University of Michigan Consumer Sentiment Survey. A whole lot going on in markets at the moment. Catch our market news section to stay updated on what's going on. You can follow me on Twitter, or the Think Markets handle is there as well. And we do have some upcoming events for you to consider. Okay, the disclaimer before I leave you today says that everything we've discussed is general in nature. Please consider it very carefully. Also consider that we are a regulated Australian broker. We do have some products that could see you lose more than your deposits. Give us a call. Check the website for further details. Otherwise, all the best for your trading until we catch up again. Bye-bye for now.